Well, wage growth in the March quarter has been weaker than expected on an annual basis, rising 2.4%, with headline inflation at 5.1% over the same period. It's pretty clear wage growth in real terms is going backwards. Well, joining me now is Paul Bloxham, the Chief Economist, Australia and New Zealand at HSBC. Paul, thanks for your time today. So wages are going backwards in Australia. When do you expect wage growth to start catching up to inflation?
Well, we think wages growth will start to trend higher as we look into the coming quarters. You know, as you said, it's running on the wage price index at 2.4% year on year in the first quarter. We think you're headed to a rate of about 3% by the time we get towards the end of this year or early 2023. At the same time, inflation will still be quite strong over that period of time, so real wages will probably still be going backwards. But as you run into 2023, we'd see inflation starting to come down again, and at that point, those real wages will start to steady. And that's one of the challenges we face, of course. The other aspect, of course, is with the RBA lifting interest rates and set to slow the economy down and cool the housing market. There are a lot of forces at work that are likely to mean that the consumer is perhaps a little less willing to do some spending, and we're seeing that already reflected in the weaker consumer sentiment. So I think that's going to mean that we are going to see, although growth has a fair bit of momentum at the moment, a slowdown in growth into the latter part of this year and into 2023.
Private sector wages increased faster than the public sector in that quarter. Is the only real way to get a pay rise at the moment by changing jobs?
Well, that's certainly one way you can get try to get a wage rise, and it's a typical pathway as well. I mean, if you look through the past and you look through historical episodes of where wages growth gets momentum, it's partly about changing jobs. One thing to keep in mind in all of that is there would have been fewer people changing jobs through the pandemic. I mean, the uncertainty associated with that, and now we might get more of a flux of turnover of the labour market, and that in turn will start to generate a bit more wages pressure. I mean, the other way to do this is to bargain with your existing employer, and then the other way, of course, is that you get things like the lift in the minimum wage when that comes around, and the way that feeds through to the enterprise bargaining agreements and underpins union demands as well. So all of those mechanisms at work. The fundamental thing, though, is the labour market's tight. We've got employment numbers out tomorrow. We think the unemployment rate's going to edge even lower. And a tight labour market also generates, over time, some upward pressure on wages growth.
Yeah, previously the Reserve Bank has suggested it would not be lifting the cash rate until wages reached 3 to 4% in annual growth. They hiked rates earlier this month. So what has changed with the RBA's thinking?
Oh, look, it's a really interesting question. I think part of the story is the primary part of the story here is that inflation has surprised the RBA tangibly to the upside for a couple of quarters now, actually, for 3 quarters. And then that last print that we got for the first quarter of this year, it was a really decent upside surprise. So inflation's gotten going a whole lot faster than they thought it would. And they felt compelled that even without the pickup in wages growth that they were looking for, or at least seeing it in the actual quarterly numbers, they felt compelled to lift interest rates anyway. So the bottom line is they changed the way they approached and set monetary policy. They were saying that they were going to wait for wages growth to lift to 3 to 4%, but as it turned out, they felt that they needed to go just because the inflation numbers were picking up. And so, although, as the RBA pointed out, there's evidence in the surveys, in the business surveys and their own business liaison that wages growth has probably got more momentum just in the past couple of months. They didn't deliver as they had said they would. They didn't wait for it to become 3 to 4% wages growth in these broader indicators. They went because inflation picked up more quickly than they were expecting.
Money markets have a 78% chance of the Reserve Bank lifting rates next month by 40 basis points. So what's HSBC's expectation?
Oh, look, we think they're going to lift interest rates next month, in June, in July and in August. We think they've become inflation fighters, and that's evident from what they said. And as I say, the fact that they've shifted to focusing on inflation and less focused on wages growth, and it's about the idea that inflation's too high. So I think they'll go in June. We can have a debate right now about whether it's 25 or 40, but honestly, it's very hard to know at this point in time. We're penciling in 25, but it depends a lot on the data flow up to that point. We get some labour market numbers tomorrow. We get some GDP numbers ahead of the RBA's meeting. We get the collection of wage indicators. We've got global events that are going on. So I would be comfortable saying they're lifting rates in June. Our central case is 25 basis points. And as we get closer, we'll know a bit more about what sort of information they've got about whether they could decide to go a bit more or not.
Really quickly, Paul, we don't have much time left at all, but tomorrow you expect the unemployment rate to fall to 3.9%?
Yeah, that's our central forecast. It's been edging lower, and it was almost there last month, actually, on a 2 decimal place basis. It only just rounded to 4. So we think, employment growth of 25,000, a slight bump in the participation rate and the unemployment rate edges down a little bit further. We think there's still quite a bit of momentum in the labour market. I think where we
Paul,
differ
thank you.
is we think some of that momentum's going to get lost later in the year.
We've run out of time. Thanks so much for coming on the show.